Welcome to the Deep Dive. We're here to break down complex financial reports and really pull out the key insights for you.
Yeah, make it quick and understandable.
Exactly. So today, we're drilling down into Chevron's latest earnings call. We want to get beyond just the surface numbers, you know?
Right, look at the strategy, what it might mean going forward. We've got the transcript, analyst notes, the whole lot.
Our mission, as always, is to cut through the jargon, deliver the essentials.
And this report, it really paints a picture, doesn't it? A company executing well on its core business, but also thinking strategically about the future, energy demands, tech shifts.
It's definitely more than just profits and losses. It's about understanding their priorities, where they see things heading. Okay, so let's kick off with the headline figures. First quarter earnings reported at $3.5 billion. That's $2 per share.
And adjusted, it's a bit higher, right? $3.8 billion or 2.18 cents per share.
Correct. But what really jumps out, I think, is the cash return to shareholders, $6.9 billion through dividends and buybacks.
That's a massive number. And it fits a pattern, doesn't it?
It really does. They've pushed over $5 billion back to investors for, 12 quarters running now?
Yeah, 12 consecutive quarters. That kind of consistency, it suggests really strong cash generation.
And a clear focus on shareholder value.
Yeah.
Sends a signal, right? Reliability.
Definitely. Now, interestingly, their organic capex, the money they spend on projects, was $3.5 billion.
Lowest quarterly total in 2 years, actually.
Yeah, but there was also that $400 million in inorganic capex.
For that new venture, the AI data center power solutions thing, we'll get more into that later.
Right, and operationally, cash flow looked healthy, $7.6 billion, if you exclude working capital movements.
One other financial point just to flag up front. They issued $5.5 billion in new long-term debt.
Which probably ties into the Hess acquisition, wouldn't you say?
Well, almost certainly. They acquired nearly 5% of Hess's common shares.
And that merger completion, when it happens, is expected to cut Chevron's outstanding shares by about 16 million.
So deploying capital for both, sort of immediate shareholder benefit, and that longer-term strategic positioning with Hess.
Exactly.
Okay, let's unpack this capital allocation thinking a bit more. That consistent $5 billion plus return for 3 years straight. That's a strong statement.
It really is. And like you said, the Hess acquisition looks like a calculated move in the consolidation game.
But at the same time, they're focused on efficiency.
Very much so. They've trimmed their 2025 capex and affiliate capex budgets combined. That's $2 billion less than last year.
And they've got this target, $2 to $3 billion in structural cost savings by the end of next year.
Right. So it's this drive to optimize, improve profitability from what they already have.
Makes you wonder, though, does that efficiency focus maybe limit more aggressive growth down the line?
That's the question, isn't it? Balancing efficiency with future opportunities.
And for income investors, that dividend story is pretty compelling. Increased for 38 years running.
38 years with another 5% bump earlier this year. That screams stability.
And their balance sheet backs it up. Net debt ratio is only 14%.
Well, below their target range of 20-25%. That gives them a ton of financial flexibility, to pursue deals, weather storms.
Plus the history of share buybacks, 18 of the last 22 years.
It all points to that commitment to returning value.
Their annual buyback guidance, it's still pretty hefty, $10 to $20 billion, depending on the market.
Right. They give themselves some wiggle room based on conditions. For Q2 2025, they're looking at $2.5 to $3 billion in repurchases.
Seems like they're ready to be nimble.
And they keep reiterating that they want to get back towards that 20-25% net debt ratio over the cycle. Suggests a disciplined approach.
Okay, switching gears a bit. Let's talk operations. Some really positive news from Kazakhstan, right? The Tengiz Future Growth Project, or TCO.
Yeah, TCO. Reaching nameplate capacity in just 30 days. That's way ahead of schedule.
That's huge. What does that mean practically?
Well, faster ramp up means increased cash distributions coming back to Chevron sooner. They specifically mentioned a $1 billion loan repayment expected in Q3.
So a direct boost to the financials there.
Definitely.
And closer to home, in the Gulf of Mexico, first oil at Ballymore this month.
That's another key project, part of this wave of startups that they expect will add around 300,000 barrels of oil equivalent per day by 2026.
And the wells at Ballymore sound pretty impressive.
Yeah, the initial performance, they're talking about 25,000 barrels a day each from the first 3 wells. 2 are online now, 3rd later this year.
Wow. And they're also some of the hottest wells seen in the Gulf.
That's right, around 325 degrees Fahrenheit. So high productivity, challenging conditions really highlights the potential there.
And staying on the Gulf Coast, the Pasadena refinery expansion is done and online.
Which strengthens that whole integrated value chain. They can run more of their own Permian crude now, capture the full margin for exports.
And they also mentioned synergies between Pasadena and their Pascagoula facility.
Yeah, for intermediate streams, managing maintenance turnarounds seems like smart operational efficiency.
And their asset sale program seems to be going well too, getting good prices, but still keeping some potential upside, like in East Texas gas.
It all fits that narrative, doesn't it? Strategic sales, operational tweaks, leadership changes they mention, all pushing towards more efficient execution.
Looking longer term, they've bulked up their exploration portfolio significantly.
Over 11 million net acres added since the start of last year.
And then there's that move into power solutions for AI data centers. That's what's interesting diversification.
It really is. Betting on a sector with potentially massive growth. That $400 million inorganic spend last quarter shows they're serious.
They're trying to get to a final investment decision before year end, right?
Yeah, FID by end of year. They mentioned strong customer interest, narrowing down sites, secured turbine pricing, but keeping an eye on other costs.
And they're also involved in a pipeline project in Argentina, looking at export capacity there.
Shows a broad view of global energy infrastructure needs.
Okay, let's dig into the earnings components a bit. Adjusted upstream, so oil and gas production basically flat compared to last quarter.
Right. Higher prices they got were offset by lower volumes and lower earnings from affiliates. Mainly higher depreciation at TCO, actually.
Because it started up faster.
Seems likely, yeah. But downstream refining and marketing, that was up.
Driven by better refining margins and less downtime for maintenance.
Makes sense.
Operationally, overall production was flat quarter on quarter too.
Yeah.
Asset sales balanced out by TCO and the Gulf startups.
But they expect Permian production growth to pick back up in Q2. More fracking activity planned.
Still focused heavily on the Dilrard Basin within the Permian.
Yeah, about 85% of the program there for 2025. Similar type curves expected to 2024. Oil cuts holding steady around 43-45%.
More well completions coming up in New Mexico, which tend to be bigger producers.
That should help drive that Q2 growth they're forecasting.
Okay, another significant project, Aphrodite Gas, offshore Cyprus. They've agreed on a field development plan.
Initial plan involves a floating production unit, about 800 million cubic feet of gas per day flowing to Egypt.
Leveraging that Eastern Med position they got from the Noble Energy deal.
Exactly. They've entered the pre-FEED stage, that's front-end engineering and design. Crucial step to ensure it makes economic sense before a final decision.
And there's established demand in Egypt, so potentially quite significant.
Could be.
How about the chemicals business, CPAM? Sounds like it's in a tough part of the cycle.
It is. Lots of new industry capacity has come online. But Chevron seems pretty optimistic long-term.
Citing our feedstock advantage, right? Ethane in the U.S., Gulf Coast and Middle East.
Yeah, and they've got growth projects underway in Qatar and Texas, due online late 26, early 27. They even hinted they might buy the rest of CPAM if the price was right.
Shows long-term confidence despite the current headwinds.
It does. They see it as a good business with execution capability.
What about their partners in the Permian? Any slowdown there?
Apparently not. They said they haven't seen any significant pullback from their non-operated JV partners, mostly big companies in core areas.
And most of the wells planned for this year are already spudded or drilled.
Right. So high confidence in that production and also in their royalty income provides a reliable base.
They also bumped up their expectation for cash coming from affiliates this year.
Yeah, to $2 billion now, up from $1 billion previously, mostly driven by that TCO early startup and a better outlook for CPAM margins.
Dude, TCO's early success is really flowing through.
Definitely showing up in the affiliate contribution forecast, though the full-year dividend guidance from affiliates hasn't changed.
Got it. They also emphasize how their overall portfolio is shifting, more low-decline assets now.
Exactly. Big LNG projects, the TCO expansion, capital-efficient shale. It provides more stability, and they keep highlighting their capital flexibility.
Already cut the budget by $1 billion from last year. Capex to cash flow ratio is low compared to peers.
And almost 2/3 of their capital is short-cycle shale or projects finishing soon. They showed in 2020 they can flex spending significantly if needed.
Makes sense. And finally, back in the Gulf of Mexico, the focus is on infill drilling, phased developments around existing hubs.
Tiebacks. They said 80% of their exploration portfolio is within tieback range of existing facilities. That's key for brownfield projects.
And break-evens for deep water have come down a lot.
Significantly. into the low teens now, apparently, thanks to better facility design standardization, makes those projects much more competitive.
They also touched on tariffs, but seemed relatively unconcerned.
Yeah, monitoring it, but direct exposure seems limited. Energy largely exempted. A lot of spending is on services, not goods. Maybe a 1% impact on a shale well cost was the estimate. They feel they can manage it through sourcing.
Okay. Let's put on our speculative hats for a moment. This is our not financial advice segment, purely for discussion.
The outrageous but plausible trade ideas. Go on.
All right, idea one. Given Chevron's big push into power solutions for AI data centers, this massive energy demand growth area, how about this?
Okay.
Look into smaller, maybe public companies specializing in, say, advanced microgrid technologies or super efficient on-site power generation, specifically for data centers.
So not Chevron's gigawatt scale, but the power within the center.
Exactly. Delivery, reliability, efficiency at the point of use. It's playing the same AI infrastructure boom, but maybe different risk-reward profile. Tangential, but crucial.
Interesting angle. Okay, my turn. With Chevron's focus on cost discipline, streamlining, maybe more asset sales.
Yeah.
Consider a potential short on a maybe regional transport company, one that's heavily reliant on moving crude or products in specific areas where Chevron might be pulling back or selling assets.
So if Chevron reduces activity in, say, Basin X, the local trucking or pipeline company heavily dependent on them might feel the pinch.
Precisely. Leverages that efficiency drive, potentially creating headwinds for companies reliant on the old footprint. Again, outrageous but plausible.
Yeah. Definitely things to chew on. Remember, everyone, that's just brainstorming, not advice. Do your own research.
Absolutely.
So that pretty much wraps up our deep dive into Chevron's latest earnings call.
Covered a lot of ground. Financials, operations, strategy, even those speculative ideas.
We hope breaking it down this way was helpful. What stood out most to you from the call? Any questions still lingering?
Yeah, jump online, join the conversation. Let us know your thoughts.